Good evening, everyone. I welcome you all to this live session of ICAI. Let's wait for seconds maybe till all the participants running in the meeting room. Good evening, everyone. So I hope everyone is doing good. The students have already joined the waiting room, and also quite a few are active on the portal. Okay, so today's session we will be taking one more interesting topic, finance. That's the topic of leverages. Very simple topic, yet very logical and also very interesting to learn about this new concept. Okay, so topic of leverages, it's connected to somewhat I can say to ratio and also to some extent to the capital structure. Uh, and it's going to be based on simple three formulae, but the concepts are really intuitive and interesting. So this leverages, you find it in our module one study material, and that goes around a lot of conceptual things that we are going to. So first, let me focus on this word called as leverages. Let me just break this word into two. One is, ever heard of this term lever, everyone? Have you heard of this term lever anytime? Anywhere? Yeah. Have you ever heard this term lever? It's not, remember, it's not Liver, it is Lever. Have you ever come across this term of lever? Your school days, maybe? Ever seen this term? Some in physics you might have heard this concept called as lever. So I just like to connect, just try to recall this term of lever and the instrument of lever before we take forward what this term has connection with in the finance. Some of the examples which you might have heard. One is a bottle opener, with which you open your uh, drink or a bottle. One more example could be, a seesaw that you see in the garden, right? Uh, Another could be just a normal simple rod. Right? The simple rod, what you can do is, if suppose you have a big rock, a heavy load lying somewhere, you want to just move it aside. Just use a simple, iron rod with which you just put some pressure on that gets shifted together. There are some types of lever. Case of a piece also, there is a fulcrum in between, and then you have maybe a load over here, and you apply the pressure over. Based on that, based on the position of the lever and load, say there are some types of lever. I'm not going to tell about the physics, but just wanted to connect that what these types of levers are actually doing for us. All these instruments, what are they really instrumental to us? Talk about bottle opener or a seesaw or a simple rod also. They were all actually simplifying our task, right? Or you can say the activities which was not possible with our bare hands. It was possible for us to do that because of these instruments. Bottle opener, as far as bottle opener is concerned, I cannot open the bottle with my bare hands, right? The soda bottle or the glass bottles that have the caps on that, you cannot open it with your bare hands. But that task can be easily done uh, by this bottle opener. Really, you cannot lift a heavy person with your bare hands. You can definitely make that other person sit on the other side of the seesaw. When you apply a bit of pressure on the other side, you can see that the other person lifts up. Same goes with this. blockers. All these levers are essentially uh, being used for the purpose of defining our activities. They're essentially used for defining our activities. So we're able to attain great results. We're able to obtain great results on our efforts. So the activity or the role which lever was playing in our day-to-day life, which we have learned in physics, is we were able to attain some of the really challenging tasks or some of the great results, some smaller amount of efforts. In finance also, we are going to observe some concept in the financial statements similar to this lever, similar to this uh, task that a lever does. In finance also, in the financial statements, you find there are certain terms or there are certain actions which the company takes based on which it is able to attain greater results from smaller effort. It shown to you with the help of certain numbers by drawing up an income statement in front. Let me just have an income statement. I hope you all are aware of uh, the financial statement that is in a very simple form. So, income statement. We start our income statement with the term of sale. So, let me say that we are going to have certain units. So, let's say initially we are selling 10,000 units. Okay? And each unit we are selling at a price of, let's say, 100 units. So, of course, our sales is going to be 10,000 multiplied by 100. In this, we are saying per unit, it's 100 unit that we are selling. That is fetching us 100 rupees revenue. From sales, we subtract variable cost, and let us say variable cost of the product that we are selling right now is, let's say, 40 per unit. It is 40 rupees. So it's multiplied by 40. That's going to be our variable cost of 4. I hope you all are aware that sales less variable cost is going to give us an important term called as contribution. Right? So sales less variable cost, we are contributing. Of or you can say per unit it works out to be rupees. Okay. From the contribution, will reduce the fixed cost. Contribution amount reduce the fixed cost. Let us say the fixed cost is 2 lakh. And after that, we have earnings before interest and tax. Contribution less fixed cost plus a PBIT of 4. And in ratio analysis also we have learned this concept that up to date that we observe the income statement, up to the point you have the EBIT, all the numbers are operating part. All the numbers are operating part. Beyond EBIT, whatever numbers we are going to arrive at, that purely depends on how you have financed your business, right? Up to this point, wherein we're talking of from sales till your EBIT, entire part is a operating part because you get your EBIT figure based on your decisions that you have taken, based on your decision as to what will be the amount of fixed cost, right? So as the fixed cost changes, you get this. So whatever number you get, whatever result you get in your EBIT, that's a result of the operating decisions. Now from further beyond this, after EBIT, we will be reducing the interest part. Interest that we pay. Can I say interest will be payable not because I'm doing my business, but interest will be payable by me because I'm financing my business with debt. I'm financing my business with 10th. Okay. So we'll reduce the interest from the EBIT figure. So let's say interest amount is another 1 lakh. So another lakh, we are having the interest amount. We get profit before tax from EBIT. Once we have paid the interest component, what we have is profit before tax. And we get a profit before tax figure of course, profit before tax is not what our shareholders are going to receive. Our shareholders are definitely going to receive the after tax income. We need to reduce tax. So let's say tax is at the rate of 30%. Tax at the rate of 30%. Uh, we 3 lakh into 30%, 90,000. Finally, we have a profit after tax of 2 lakh 10,000. And then if I want to know what is the earnings for each of my shareholders, what is my earnings? I need to divide it by the number of equity shares. Divide it by the number of equity shares that we have. For example, we have 1 lakh equity shares outstanding. I can get the EPS figure as 2 lakh 10,000 divided by, have the EPS of 2.1. We have the EPS of 2.1. So at 10,000 level of sales, 10,000 units of having a EPS figure of zero point 0.1. Okay. Now, sir, you were saying something, there will be some concept called as lever. We will be able to see some sort of, less efforts but more results. We are just on the verge to reach that point. So initially, you were putting some efforts to make sales and you were able to attain a sales of 10,000. That is resulting in an EPS of 2.1. Now, suppose you put an extra effort. Suppose you put some extra effort, and that extra effort is actually causing this 10,000 units increase by certain percentage. So let's say you put 10% extra effort. You're putting in 10% extra effort. So, okay, so putting in 10% extra effort. So can you tell me what will be the units? The units that we will be selling beyond this will be 10,000 into 1.1, 11,000. Units will be 11,000. 10,000 increasing by 10% will make our units 11,000. Now I want you guys completely fill this income statement. Just give you a minute. Quickly fill up these entire numbers. Just you can write down whatever numbers you're getting. Yeah, just a minute's time for you. Fill up this entire income statement. Say, if I'm able to increase my units of sales from 10,000 to 11,000, what is the resultant impact on the increase? Just give me all the numbers that we have. For me, it is easy because I just right. I just want you guys to calculate the numbers. Yeah, just keep on adding the numbers, guys, and give me the final EPS figure. When you complete this entire column, give me the final EPS figure. Yes. What's the EPS figure, everyone? Then the sales will be 11 lakh, right? Variable cost is going to be 4 lakh 40 because each unit is going to be cost plus the variable cost is concerned for itself. So variable cost will be 4 lakh 40. Okay. Then the contribution figure, since per unit is going to remain same, contribution is going to be 6 lakh 60,000 because units are increasing. Of course, per unit wise, you can see the contribution. But the fixed cost will remain same as, right? So cost is going to remain same as 2 lakh. Then you observe EBIT will be 4 lakh 60,000. Interest won't change because interest is again a fixed cost. Profit before tax be 3 lakh 60,000. And now the tax is going to be 30% of 3 lakh 60,000. Get a profit after tax. Number of equity shares remaining same, 1 lakh. So now the EPS will go to be 0.5. This is now 0.5. Okay. Are you all getting this EPS? Just confirm guys. We get this EPS figure with the increased sales. So when we are increasing the sales by 10%, are we observing that EPS is increasing by from 2.1 to 2.5? Now it's time for us to calculate the percentage changes. Time for us to calculate the percentage changes. Let us say percentage change. So we stated that units, when it increased from 10,000 to 11,000, that units are increasing by 10%. So as the units are increasing by 10%, we already know that this is 10%. So what is the percentage change in sales? But obviously, it's going to be how to calculate the percentage change. Percentage change is basically new value minus old value divided by the old value. New value minus old value divided by the old value. That gives us a percentage change to be 10%. What percentage change now for all the subsequent numbers? Here we have these numbers. Now, I just want you guys to focus on certain numbers that I'm just highlighting. Just have a look at it. Certain numbers that I want you to get. The change in EBIT. Get the change in EBIT followed by the change in profit before tax. And of course, you can see profit before tax and all other numbers, percentages. What do we observe over here? See, when I'm putting 10% extra effort, when I'm putting 10% extra effort, so my sales increases from 10 lakh to 11 lakh, which is I'm observing 10% is a change in the sales. If you look at the change in EBIT, the EBIT has changed from 4 lakh to 4 lakh 60,000, but that change is actually translating to 15%, right? So this percentage change in EBIT translating to 15% change in the EBIT. And you can see the PBT is also increasing by higher than 10%, which is 20%. So let me just focus first on this part. Let's focus first on this part, guys. So this portion, as we have stated that this is the operating portion. Our operating portion. So whatever is happening as far as the operations are concerned, uh, we are going to cover that right now. So as far as operations are concerned, when the units sold is increasing by 10%, we see that the EBIT is increasing by 15%. So now my question is, uh, the percentage change in EBIT is higher than the percentage change in the sales. Took an additional effort of 10% increase in sales, took additional 10% effort that resulted in a EBIT increasing by 15%. Is higher than your effort, right? So I simply say percentage change in EBIT on percentage change. What we observe is in regards to the percentage change in EBIT, we observe that percentage change in EBIT is 15%, and the change in sales is 10%. Just divide it. That's simply 1.5 times our number of 1.5 times. This 1.5 times is a resultant impact. This 1.5 times is the resultant impact of the leverage that we are talking. Remember, we connected it with the lever part, wherein lever was, by which you were able to perform greater activities with much ease. Means that you had a lesser amount of effort, but the result was greater. So over here also, when we have this 1.5 times as a number, it means 1% additional effort that you put in will result in 1.5% additional result for you. 1% effort will lead to 1.5% result. Therefore, we say that this particular number is nothing but operating leverage. This number 1.5 times, call it as a operating leverage, and that is simply computed as percentage change in EBIT. 1% change in. You can also say this is something similar to what you have learned as derivatives or differentiation in your foundations, where it was a change in y due to change in x. So this is change in EBIT due to change in sales. So operating leverage, which is 1.5. If it is 1.5 times, it means 1% change in your sales will result in 1.5% change in EBIT. Or you can also analyze this as you can analyze this as uh, change in sales will be 1.5 times of change in EBIT, change in your earnings before interest and tax, or change in your operating profits is going to be 1.5 times of change in. Okay, you can also say this as, as an interpretation, 1% change in sale will lead to 1.5% change in EBIT. Right? Now my question is, having a leverage in your financial statement is triggered by this portion called as a fixed operating. Having a leverage in your operating part is triggered by the fixed operating cost. This fixed operating cost, everywhere it is 10%, but then the figures change as soon as you cross the fixed cost barrier. As soon as you cross the fixed cost barrier, now change in EBIT that you observe is 15%, which is more than 10%. That's because fixed cost has remained constant. The fixed cost has remained constant. So what you observe is that whatever is the change in the EBIT, that is the resultant of change in contribution, but fixed cost has remained same. So as percentage wise, EBIT is a much larger thing, right? That's your operating leverage. Similar sort of leverage is what we observe in the financing portion. Because once EBIT is earned, now operations part are done. Now whatever you have, is going to be the financing part. So this portion from EBIT till your EPS number is going to be your financing. Okay. So from interest onwards till EPS, whatever numbers you have, that will be the result of your financing decisions, how you have financed your business. So now financing aspect also we will observe as your EBIT increases from 4 lakh to 4 lakh 60,000, as your EBIT increases from 4 lakh to 4 lakh 60,000, interest is not changing. Interest is kept constant at 1 lakh itself. But your profit before tax increases from 3 lakh to 3 lakh 60. And the resultant change is what you observe as 20%. So EBIT was changing by 15%. PBT is changing by 20%. Same percentage you will observe even for tax, even for PAT, and even for final earnings per share that we see for share. Right? Now, if I ask you, how sensitive is my earnings to the EBIT? I want to know how many times of change in EBIT will be the result in the earnings per share, or how elastic my EPS is to the change in EBIT. You might have learned elasticity of demand in your foundations. Right? So, as far as EPS is concerned, EPS has changed from 2.1 to 2.5, which is a 20% hike. It's a 20% rise. I'm looking at percentage change in EPS comparison, percentage change in EPS. So whatever is the percentage change in EPS due to percentage change in EPIT, we are looking at the financing component of the of our financial statement. So in this case, say that percentage change in EPS on percentage change in EIT will be like 20%, on percentage change in EBIT is 15%. Let's try to calculate it. You can say 20% divided by 15%. So in terms of times, we get that as 1.33 times. Get this as 1.33, right? So it's 1.33 times. And this is what we call it as financing level or financial level, right? 1.33 times. What's the interpretation of this number? If your intent, your earnings before interest and tax is changing by 1%, EPS, in fact, your profit before tax, your profit after tax, numbers are going to change by 1.33%, right? So, the sort of analogy we can give for financing, wherein we say change in S will be 1.33 times of change in EBIT. Change in EPS will be 1.33 times of change in EBIT. Or we can also say 1% change in 1% change in EBIT will lead to 1.33% change in EPS. Change in EBIT and EPS are connected by the financial leverage. Are we good with these two formulas right now? Everyone? Are we clear with these numbers, the interpretation of these numbers? It is quite obvious. Higher these numbers, higher are the sensitive. There any query till now, just put it in the chat box, guys. Okay. Okay. So let's go ahead. Let's take it forward. Uh, uh, Now finally we are connecting next aspect, which is percentage change in percentage change in EBIT, percentage change in percentage change in EPS due to some percentage change in the percentage change in EPS that you observed it to be 3%. For what percentage change in sales? Well, sales was changing by 10%. I just try to write down this number, that's 2. And this figure of 2 times is said to be combined leverage. This is what combined leverage. Percentage change in EPS upon percentage change in sales, if we observe, that's 20% upon 10%. That gives me answer as 2 times. Okay. So if you can just try to connect what would be the analogy that we have over here for the combined leverage. Combined leverage is going to connect the revenue, which is the top line, with the bottom line as what we looked at. Yes. Combined leverage, we say uh, change in EPS will be 2 times of change in EPS will be times of change in the sales line. Okay. Change in EPS will be times of the change in sales. You can also say that 1% change in sales will lead to 1% change in sales will lead to 2% change. Yes. Okay. So I've got three leverages. One is the operating leverage, financing leverage, and the combined. Operating leverage connects your sales with EBIT. Financing leverage connects your EBIT with EPS. So combined leverage connects the sales. Okay. So you can say operating leverage uh, is sales to EBIT portion. Financing leverage is from EBIT to EPS, and the combined leverage is from sales to EPS. Okay. So this is how we are connecting the numbers. We've got three leverages: operating leverage, financing leverage, and combined. Operating leverage is looking at percentage change in EBIT due to percentage change in the sales. Financing leverage is looking at percentage change in EPS due to percentage change in the EBIT. And the combined leverage connects the percentage change in sales with that of percentage change in EPS. Okay, so now my question to you is, having this leverage is triggered by what aspect? Well, leverage is triggered by something called as this fixed cost over here, and the interest part, something that is causing the leverage to be there in your finances, because all the costs are increasing or decreasing, or all your revenue is increasing or decreasing as per the level of your units. But these items are remaining same; they are not at all changing. So now, how do we go about looking at this leverage? If I ask you, having leverage in your financial statements, is it a good thing or is it a bad? Financially, is it a good thing or is it a bad? Yeah, tell me guys. What do you feel? Having financial leverage in your books, is it a good thing or is it a bad thing? Tell me guys. What do you feel? If you feel that it is good, let me just show you something additional now. We have calculated everything. Now, looking at percentage changes in all the items, right? But uh, if we look at the other aspect, suppose if I reduce my effort by some percentage, suppose if I reduce my efforts by some percentage, let's say if I reduce my effort by 10%, so my efforts, 10,000. When I increased it, I found that it is, everything is favorable. I'm getting greater percentage change. That's a good thing which was happening. Now we are going to reduce the units. Say if we are going to reduce the units by 10%, let's have a look at what's happening with the numbers. Just try to calculate these numbers, guys. So reducing by 10% means now the units will be 9,000, right? For 9,000 units, try to calculate what all will be the figures over here and give me the final EPS figure. Give the final EPS figure. Okay? For reducing the units from 10,000 to 9,000, just check what is happening to your units and also of course all the financing figures. Check what is happening. Give me the EPS figures. See what is happening. Yeah, so PAT is 1,68,000 and EPS is 1.68. Okay, have sales figure as 9,000, and the variable cost contribution is 550. Fixed cost is going to remain same. Okay, 80 unit contribution minus fixed cost. Interest, if again, since it's a fixed cost, that's going to remain same 1 lakh. PBT is at 40. So on that you're going to pay tax of 30%. Have after tax of 1,68,000. 1 lakh is the number of equity shares, and you get fixed 1 point. Okay, so these are the numbers that we are getting. Right, 1.68 is the EPS. Now just check what is the percentage change. Percentage change is again doing the same thing. New value minus old value divided by the old value. Percentage wise, to observe that there is a reduction in units by 10%. Sales are also reducing by 10%. Labor cost also reduces by 10%. Fixed cost also, fixed cost is not only, but yes, it reduces by 15%. And similar percentage changes even in the other aspects. But what's more important is, as we were observing that small increase in efforts is causing substantial increase in the profits. Similar thing is observed in the downside. So efforts are getting reduced by small percentages. You find that change in EBIT now it is more prominent on a lower side. You can say there is a change in EBIT by 15%, or change in sales by 10%. Now for PBT also, to observe a similar change in the percentage, right? So if you have a leverage, it means if you have a leverage, it means you can have favorable numbers or you can also have unfavorable numbers. So if you have a EBIT, increase as the EBIT was changing by 15% on the positive side, it can also fall by 15%, right? It can also reduce by 15% on the negative side. So this thing, as you were saying, that it's a good, rather I can say it's good as well as bad. Both situations was the good thing as well as the bad thing because you can attain greater result with smaller efforts. You're also going to lose to a greater extent. You're also going to lose to a greater extent if you're going to reduce your effort by smaller amount. Okay. So therefore, we say that leverage is nothing but good as well as bad. Whatever you say that it's good as well as bad, but it's the risk, right? So it's a measure of your risk as far as your operating risk or leverage is concerned. As far as your financing part is concerned, financing risk or leverage is concerned, is going to be computed in this way, percentage change in EPS upon percentage. The overall risk of the business will be computed as combined risk or leverage. Combined risk or leverage is what we are computing by way of this. Okay, so we have covered the three ratios, not types of leverages, with the respective examples, along with justification as to why we say that it is. First, increase in sales can increase your EAT and profits by a greater proportion, when it can fall by greater proportion. That's the scenario. We see that these are measures of risk. Okay, so we have these three formulae as we have stated over here. These three formulae of operating, financing risk, and the combined risk. But yes, now it's time for us to look at some shortcut formulae also for these numbers. Because every time if I want to compute my level of risk, I need not prepare my base financial statement, then increase it by 10% or decrease it by 10%. That's not going to be something which we are uh, formula arrive at these numbers. Let me derive shortcut formula for you guys. Now quickly calculate these numbers of operating leverage, financial leverage, and combined leverage. Let me just show you some of the shortcut. Well, operating leverage, it's computed as percentage change in EBIT upon percentage change in sales. Right? Prominently, I want you to observe is percentage change in EBIT upon percentage change in sales. The percentage change in sales that you observe, same as percentage change in variable cost, that also is the percentage change in the contribution, right? The contribution is also changing by 10%. So as far as percentage change is concerned, the numerator I'll keep it as percentage change in EBIT, but the denominator portion, percentage change in sales, I can say it is same as percentage change in contribution, right? Because whatever is the percentage change in sales, you observe that in the contribution also that same is the percentage change. Percentage change in EBIT is computed as, new EBIT, EBIT 1 minus old EBIT, which is EBIT 0 upon EBIT 0, which is the old EBIT, right? This is how we come up with percentage in EBIT. That's into 100. Then the whole thing is divided by percentage change in contribution is computed as contribution 1, which is a new contribution, minus the old contribution, right? Say it is contribution 1 minus contribution 0, old contribution, the whole thing divided by contribution 0. And this also is multiplied by 100. And we can obviously cancel out this 100 and we are left out with just EBIT minus EBIT 1 minus EBIT 0 upon EBIT 0. The same goes with the contribution. If I just rearrange it, no simple mathematical simplification, that's EBIT 1 minus EBIT 0 divided by EBIT 0 into contribution 0 on contribution 1 minus contribution 0. Right? Prominently, I want you guys to look at these figures. EBIT 1 minus EBIT 0 and contribution 1 minus contribution 0. What you observe is the change in contribution, the amount-wise change in contribution. Here we observe that contribution changed from 6 lakh to lakh 60. What was the amount of change? That was 60,000, right? And what's the amount of change in EBIT? It increased from 4 lakh to 4 lakh 60,000. EBIT increased from 4 lakh to 4 lakh 60,000. And contribution also increased from 6 lakh to 6 lakh 60,000. Amount wise, the same thing. Right? Amount wise, it's the same figure. So we can say that amount wise change in EBIT and contribution is equal. Amount wise, it is equal. So you can say both of them will get cancelled. And what we are left out finally is, contribution upon or contribution 0 upon EBIT. We left out this contribution 0 upon EBIT. Now, contribution 0, it means the base contribution. This contribution is 6 lakh and EBIT base is 4 lakh. If you just divide it, contribution 0 is, the base contribution is 6 lakh and base EBIT is 4 lakh. So if you divide it, that's just 6 lakh divided by 4 lakh. That's 1.5 5 times. That is 1.5 times. Okay, if you get it, yes. If it was a long cut method by calculating all the percentage changes, you get the same number 1.5. And even if you use the shortcut of base contribution divided by base EBIT, that also will be the same 1.5 times as the answer. That is with regard to the operating. Okay. Now, after this operating leverage, we do have shortcut for combined leverage and financing leverage also. I'm not going to derive it because that can be derived on the similar lines. Right? I'm just going to write it down. And frequently we are going to use this shortcut formula only to calculate the leverages. We have operating leverages contribution upon EBIT. As far as financial leverage is concerned, a similar formula is applicable, wherein we say financial leverage is EBIT, earnings before interest and tax, on profit before. There's a shortcut formula for financial leverage. You can observe it that it will give you the same answer. EBIT is 4 lakh and your profit before tax is 3 lakh. In the base part, you have 4 lakh as the EBIT and profit before tax is 3 lakhs. So if you just divide it, this is 4 lakh divided by 3 lakh is 1.33. So operating leverage is 1.5 times and financial leverage will work out to be 1.33 times even using the shortcut form. Then we have the another formula for combined leverage also. Again, the shortcut formula, we have seen the longer method to calculate it, but combined leverage also we have got a shortcut formula, which is contribution upon profit before tax. If you just try to pick up the numbers, contribution is 6 lakh upon profit before tax is 3 lakh, which is 2 times, right? So all of these three are the shortcut formulae. Calculate the leverages, be it operating, financial, or combined. We have got the shortcut. But I would like you to remember financial leverage, this formula is supposed to be used with caution. Why caution? Because we say it is not applicable. This formula is not applicable if preference dividend is paid. If we have preference dividend to be paid, then this formula is not applicable. So what's the short? Do we have a shortcut formula for preference dividend also? Yes, we do have a formula for preference dividend payment also. So what's the financial leverage for that? We definitely have a look at it right now. And also something about operating leverage and the margin of safety. That's where it is. So let me just put up in front of you financial leverage when we have preference dividend for us. For that, let me just take this same financial statement. We have. I'm just going to add one more line item into this, which is the preference dividend. We uh, down and we have entire income statement. Patch from the patch, we are not going to directly divide the number of equity shares. Rather, what we'll be doing is we will be reducing the preference dividend. So let's say preference dividend you're paying 70,000, paying a preference dividend of 70,000. What we have is net profit for equity shareholders as 1 lakh 10 minus 70, 1 lakh 40,000. Then if you just divide it by number of equity shares which we had, 1 lakh, now our EPS, it's going to be 1.4. EPS is 1.4. Now if I'm going to change the number of units by, let's say, plus 10%, additional 10 units, if 10% units we are selling, this will be into 1.1, or additional 10%, 11,000 units will be sold. So according to our sales, and all these figures are also going to change. This 11,000 multiplied by 100 your sales. Uh, and, yeah. 11 lakhs, 6 lakh 60 fixed cost remains the same, interest remains the same, profit before tax increases, less tax, we subtract that, and then preference dividend also remains a constant figure of 70,000. And what's this? No, this is 1 point. So if you look at percentage changes, find that percentage change is simply to value minus old value divided by the old, and drag it and see what's the percentage in this. Here, you observe that the change in sales is 10%, but the change in EBIT is 15%, which very well tells us that no, the operating leverage is 1.5. But when it comes to financing leverage, look at the change in, yes, look at the change in EPS. Change in EPS is now 30%. It's not, you can say that it's same as 20%. So if you apply a shortcut formula over here, which is KT upon PBT, which is 4 lakh upon 3 lakh, that's not going to be giving you a correct answer, because I'll give you 1.33. But in fact, over here, percentage change is 30% as compared to 50% change in EPS. Here, if I want to calculate the financial leverage will be computed as percentage change in EPS on percentage change in state. Percentage change in EPS is 30, and percentage change in your sorry, financial leverage will be percentage change in EPS. That is going to be percentage change in EPS is 15%. Take a difference. Let me just cannot apply that shortcut formula over here. But we have a shortcut formula for this. Yes, we do have. So financial leverage shortcut. Financial leverage shortcut formula is something like this. It will be EBIT upon profit before tax, but from that we further reduce preference dividend divided by 1 minus T. That's the shortcut formula for financial leverage. If we just apply the shortcut formula over here, see what is the EBIT figure. It is 4 lakh, right? And preference dividend, sorry, profit before tax is 3 lakh. From that 3 lakh, we need to subtract uh, preference dividend of 70,000. Is divided by 1 minus tax rate of 0. So I'm doing that. Observe that this works out to be 4 lakh divided by lakh divided by 3 lakh plus lakh minus 70,000.7. Yeah. We get this as a 2 lakh. And finally, we can say that this is nothing but this shortcut formula will also work, but provided we use it properly. Right? So the shortcut formula is also working for financial leverage. This is EBIT upon profit before tax minus preference dividend divided by 1 minus T. Okay, so that's your financial leverage shortcut formula. Remember, this is going to be applicable when you have preference dividend in your books. Don't have any preference dividend or anything, then it's all fine. Then you can use the older formulas. Okay, clear everyone? Shortcut formula for the financial leverage. You all perfectly good with it? Yes. Are you all perfect? We have learned in total four formula today. One is the operating leverage, which is EBIT, sorry, contribution upon EBIT, financial leverage without preference dividend, which is EBIT upon profit before tax, combined leverage, which was contribution upon profit before tax. And now we have this financial leverage when you have preference dividend in your financial statement. One more formula that we are going to look at of implication of margin of safety and the operating leverage. Right? If I ask you, are we all aware about something called as margin of safety? Learned it in costing, cost accounting, margin of safety. Margin of safety is basically over and above break-even sales, whatever you are selling, right? We have learned something called as break-even, where break-even point, break-even sales is basically the sales at which your cost and revenue is just same. Margin of safety in percentage terms is like sales minus break-even point. Break-even point, the sale that you have over and above the break-even point. On 200, you do it as just to make it as a percentage because ignoring that part. So if your, let's say, break-even point is, let's say, 30,000, and if you're selling 50,000, so additional over and above the break-even point that you have is what we call it as margin of. And in this same formula, we are just going to do a bit of uh, uh, simplification with arithmetic. What I do is, um, let us say I'm multiplying PV ratio in numerator as well as denominator. I'm multiplying PV ratio in numerator as well as denominator. This will become sales to PV ratio, right? Minus break-even point into PV ratio. And then again divided by sales into PV ratio, right? So when you multiply your PV ratio with sales, PV ratio is basically proportion of, it is PV ratio is simply contribution upon sale. PV ratio is contribution upon sale. So you can simply say contribution is nothing but, sir, PV ratio into sales. So this sales into PV ratio, we can say this is contribution, right? This contribution, and Even the denominator part is going to be contribution. Break-even point is the sales level, right? And you know that break-even point in costing you might have learned it is computed as fixed cost. Break-even point is fixed cost divided by PV ratio. If you are going to multiply break-even point with PV ratio, that's going to give us the fixed cost, right? Break-even point multiplied by PV ratio is we call as fixed cost. Contribution minus fixed cost upon contribution. Subtract fixed cost from the contribution. That's going to give you earnings for interest and tax upon contribution. Now just recollect what we have as operating leverage. Operating leverage is computed as the formula is contribution upon EBIT, right? Now you can just try to connect what we are talking of these two numbers. You can conclude that operating leverage is 1 upon margin of safety. Anywhere we observe that uh, anywhere you have operating leverages, when I'm here supposed to calculate margin of safety or margin of safety is given and we want to compute the operating leverage. Then we can have this simple relation between operating leverage and the margin of safety. Okay. So in total, what all formula we have done, let me quickly recap for you. Operating leverage, we have operating leverage, what we have computed, right? Let me just write down all the formula that we have. We can go for the questions. First, we calculated operating leverage, which was simply percentage change as just operating leverage. Original formula that we had, it was contribution. It was percentage change in EBIT upon percentage change in sales. The shortcut formula that we had for operating leverage, it was contribution upon EBIT, right? And we also had one more formula over here, which is operating leverage is simply computed as 1 upon margin of 50. Let me just read over here. Then, as far as financial leverage is concerned, we have got percentage change in EPS due to some percentage change in EBIT. So the shortcut formula that we have for this is EBIT upon profit before tax minus preference dividend divided by 1 minus T. Okay. And then the final combined leverage, it was percentage change in EPS due to a percentage change in sales. Again, as far as shortcut part is concerned, you can say contribution upon PBT minus preference dividend divided by 1 minus. This is what we have covered till now as far as the entire leverage is concerned. All the formula we have discussed, we have derived the formula and also done with the logical reasoning for the same form. Okay. So I hope we are clear till now. So there is a request from Pranjali. It's a May 24 leverage question. Can you please solve in your lecture? Yes, I will do it. Push the break. So let us take a break right now, small break, and post that we can start solving questions from the module and from the past question papers. Okay, so let's take a break, guys. Let's take a short break right now. Continue after. Okay, so welcome back, guys. So we have covered the formula along with the derivations. Now let's go for some of the questions and quickly take the questions from the module itself. Okay. Take up rule leverages. We'll do some questions from module, and after that, as Pranjali has asked for, I'll be doing the question from the past exam. Okay. So from the module, let me take. If you have any specific question to ask for from the module, I will definitely solve that. Or else I'll pick up the question as per my judgment as to which question you may be facing. Any specific question you have which you want me to solve? Anyone? Just place the request. If you have any such specific question where you are facing challenge. Yeah. Any specific question from what you can ask me. In case if you don't have any, let me just pick it up. Yeah. Question number 9 for our discussion. Let's take up question number 9. Yeah. The following particulars relating to Navya Limited for the year ended 31st March is given. Have for the 31st March year ending, they have been given that 1 lakh units at normal capacity, selling price is 40, delivery cost is 20. Stock is 10 lakh. Capital structure of the company as on 31st March is as follows. As on 31st March, we have the capital structure as equity share capital 10 lakh, reserves and surplus 5 lakh, 7% debentures 10 lakh, current liabilities of 5 lakh. We have the 30. Navya Limited has decided to undertake an expansion project. The market potential that will involve 10 lakhs. So it has decided to raise additional 10 lakhs. Company expects an increase in output by 50%. So, increasing by 50%. Fixed cost will be increased by 5 lakhs. Labor cost will be increasing by 10%. Traditional output can be sold at an existing selling price without any adverse impact on the market. The following alternative scheme for financing has been considered. One is raising entire money by way of equity shares. Second is 5 lakh by issue of equity shares of 10 lakh of 10 each, and balance by issue of 6% interest of 100 each. You have to raise an amount of 10 lakh, right? And 10 lakh can be raised. First option is yes, at a price of rupees 10 each. We know it is 1 lakh shares. Here, rupees 1 lakh. Second is rupees 5 lakh by way of issue of shares. Like if you're raising at 10, that's going to be additional 3,000 shares. The balance by issue of 6% debentures of 600 each at par. the combination of debt and equity. And the third plan is, issuing 6% ventures in entire. Find out which of the above mentioned alternatives do you recommend for Navya Limited with reference to risk and return involved, assuming a corporate tax rate of 40. So, remember this word, risk. We have just learned before the break. What is risk synonymous at our level of understanding? Risk is synonymous with the leverage. Whatever is the amount of leverage, whatever is the number of leverage that we have in our financial statements, that is essentially a measure of risk, right? So about three plans for all the things we need to check, what are the levels of risk that you observe in statements, and also what is the net effect on the number of equity shares also. Okay. So these are certain things that we are going to take care of first. And we need to prepare the income statement, uh, arriving it up to the EPS, and then also we need to compute the leverages. So, Alex, fine. And like regulars, uh, whatever we have in existing, and then we say plan one, plan two, plan three. So in all the three plans, we need to write down the capital structure, and also we need to calculate the risk involved in each of the three. Share capital existing, we have got 10 lakhs, right? Existing, we have got the share capital of 10 lakhs. It's to connect. Okay. Existing capital is 10 lakh. Under first plan, we're going to issue equity shares of 10 each. So we're going to have additional 1 lakh shares coming. Equity share capital will become 20 lakh. Right? And in plan, we are intending to raise 5 lakh by way of equity shares. So 5 lakh is going to increase. So existing 10 lakh plus 5 lakh equity share capital. And the third plan, this remains same. And under this equity share capital, post that we'll have the reserves. In fact, reserves, whatever we the plan, whatever be the equity plan, reserves are not going to get impacted because you're not issuing any shares at a premium. Whatever reserves we have, which is 5 lakh, that's going to remain same. 5 lakh is a constant figure throughout. Then we have 7% debentures, which are the old or the existing capital structure. 7% debentures, the tune of 10 lakh. Right? So these ventures are going to be there for investing irrespective of the plan that you choose. Ventures are issued if you're going for plan and plan three. And the cost of new debentures, as the question says, is 6%. Cost of new debentures is 6%. Is 6% debentures. There's no 6% debenture over here. Still, in plan one, 6% debentures is not there because there's easy of value of debt. In plan two, you have the debt coming in. So the tune of 5 lakh, what we have in plan. The third plan, the entire money is raised by way of debt. And we see that total capital employed capital employed will be existing is 25 lakh, but that increases by 10 lakhs to 35 lakhs. Plan 120, right? Okay, so now let's look at the income statement from each of these plans. Let's get started with sales. Sales, they say, is 1 lakh units of output, like units of at normal capacity. Now, on that, there is going to be a increase of 50%. Your number of units is going to increase. So instead of 1 lakh, now the units will be 1.5. Sales units is 1 lakh, but in plan 1, 2, and 3, it's going to be 1 lakh. Okay, so these are the units and not in terms of rupees. Sales units. Now the sales values. If you look at the numbers, the question says that company expects to increase the output by 50%. So 1 lakh sales will become 1.5 lakh sales. And then they say company expects to increase the output by 50%. Fixed cost will be increased by 5 lakh. Okay. Variable cost will decrease by 10%. So I need to consider variable cost. But there's nothing mentioned about the sale price. So I'm presuming that sales, no, it's going to be the same figure. Price is, and sales is going to be per unit. 40. It is 1 lakh into 40 is 40 lakh, 60 lakh, 60 lakh, right? We have got the sales of figure. Now, from that, we need to reduce variable cost. Variable cost per unit is 20 rupees. In the existing case, this into 20. But for plan 1, 2, and 3, for plan 1, 2, and 3, we need to notice that variable cost per unit is going to decrease by 10%. Since the variable cost is going to decrease by 10%, originally the per unit cost was 20. Was 20. Now, since your units are increasing and also your variable cost per unit is changing, variable cost is existing. Existing it is 20 and new it is 18. Because there is a decrease, right? There is a decrease in the variable cost, which is increasing by 10%. So, it's 18 multiplied by number of units. From this, we get contribution. Contribution is simply your sales value minus variable cost. Sales minus variable cost. And then from this, you have to subtract the fixed cost. The existing fixed cost versus 10 lakh. But in the subsequent years, they say that fixed cost is going to increase by 5 lakhs. For the upcoming plans, we have the fixed cost figure. Instead of 10 lakh, that's going to be okay. Contribution less fixed cost. That's going to give us earnings before interest and tax. Earnings before interest and tax contribution minus the fixed cost figure. We got 10 lakh, 18 lakh, 18 lakh, and 18. Up to financing part, all the three plans will seem equal because there's no major difference in, right? All the three plans will seem similar uh, up to the EVIT portion because operations part. Now, if you look at subsequent part, there will be changes because interest will differ as per the mode of finance. Say less interest. So interest will be debentures multiplied by 7%. Right? So interest, we have got 10 lakh multiplied by 7%. But when you go to plan 2 and plan 3, you have some other type of debenture coming in, right? So I need to consider those debenture interest also. It's going to be the 10 lakh multiplied by 7% plus 5 lakh multiplied by, that gives us a total interest of 1 lakh. And for the last plan, it is 1 lakh. That gives us earnings before tax, or you can say profit before tax. Profit before tax is EBIT minus the interest fee, EBIT minus the interest figure. So 9 lakh 30, 17 lakh 30, 17 lakh and 16 lakh 70. From this, we will reduce. We have to pay the taxes, right? So tax rate that's prevailing. Let us take the tax rate as tax into 40%. That's the tax amount. Then finally, have the profit after tax 9 lakh 30 minus 370. 558, 10 lakh 38, 10 lakh 20,000, and 10 lakh for profit after tax. Right? PBT is the taxation is subtracted, and then PAT is what we have got. So as far as PAT is concerned, these are the numbers. Now let us calculate the EPS portion also by considering the number of equities. Number of equity shares will be triggered from the equity share capital. Just need to divide the equity share capital by 10 to arrive at the number of equity shares. Then EPS is PAT divided by number of, you observe as EPS. Find that EPS is highest for the last option. Right? EPS is highest for the last option. As far as return points is concerned, it's 10.02. So return rank is a, this is rank 1. Then 6.2 is like rank 2. And this one is rank 3. As far as the choice of it is concerned, even if you can say 5.19 is lower than what we are providing is as of now. 5.58 is the current EPS. If I go with plan 1, I'll be able to just generate a lower EPS for my shareholders. So this is as far as the returns part is concerned, we get the EPS. Now, we need to also calculate the risk aspect. Now, we have the income statement in front of you. We have to compute the risk aspect. As you know, risk has to be computed taking into account the leverages. So I want you guys to this income statement. Calculate operating leverage, financial leverage, and combined leverage. So get me these 12 numbers quickly, guys. Get the income statement and calculate the leverage numbers. Give me the operating leverage, financial leverage, and combined leverage numbers, guys. You already know the formula, right? Already aware of the formulas. Just apply the formula and Give me these numbers, operating, financial, and combined leverage. Yes, check if you're getting the operating leverage of contribution divided by EBIT over here. The leverage was financial leverage, be your EBIT divided by profit before tax. Combined leverage will be in a sense just a multiplication of, right? Just check if you're getting these numbers. Or if I ask you from the overall perspective, uh, the risk point of view, banking as far as the risk is concerned, banking as far as risk is concerned, it is going to be rank one, going to be a rank number two, and this one will be rank number. Are you getting these numbers? Okay. Now, let's go to the interpretation part. As far as EPS is concerned, we also know the highest possible EPS is the last option is 10.02. But take it with caution because that last option has got a highest risk also because it has got the highest combined leverage, right? So risk as well as return, both of them are highest in that case. If you look at only the case part and just blindly go with the selection of the plan, you're actually ignoring the risk involved. Check whether the company is really able to take this level of risk. If this level of risk fits within their risk appetite, whether the company will be, able to adjust this amount of risk or whether they will be able to accept this amount of risk, then they should go for this. Go for more conservative plan where the risk is comparatively lower or maybe accept. Okay, so before any financing plan is discussed or before it is finalized, the company is really able to accept that level of risk to get the highest level of. Okay, so risk return trade off is something that we wanted to cover on this. Now, let me take one more question from the module, and then we'll do the exam question, past exam question. Look at question number 10. Let us solve this question number 10. Following details of a company for the year ended 31st March are given below. Operating leverage is 2 is to 1. Combined leverage is given 0.5 is to 1. Fixed cost excluding interest is 3.4 lakhs. Sales is 50 lakhs. 8% debentures of rupees 100 each, which is 30.5 lakhs. Share capital of rupees 10 each, which is 34 lakhs. And income tax rate of 30. Need to compute the financial leverage, PE ratio, earnings per share. If the company belongs to industry whose asset turnover is 1.5, does it have a high or low assets turnover? At what level of sales earnings before tax of the company will be equal to? So you've got the details given here. If you want to compute these all, just start it, just solve it. Because in terms of basic information that we have, operating leverage 0.2 is to 1, combined leverage 0.5. Operating leverage is operating leverage is 2, combined leverage is 0.5. Then fixed cost excluding interest, or you can say the operating fixed cost is 3.4 lakh at 40,000. Sales is lakhs. Sales is 50 lakhs. 8% debentures. 8% debentures is 30 lakh 5,000. Then we got the equity share capital 4 lakhs. Then income tax rate is 50%. We have all this information. We have to come to the financial leverage, PE ratio, EPS, and a lot of things. Let's first talk of financial leverage. Since we have operating leverage and combined leverage available for us, we just need to get simple formula of combined leverage equal to operating leverage into financial leverage. So you can say combined leverage is 2.5, operating leverage is 2, the financial leverage will be 0.5 by 2, which is 1 point. Financial leverage is 1.25 times. Okay. Now, so we have computed the financial leverage which was required. Now, the next thing that the question asks us is get the PV ratio and earnings per share. PV ratio and earnings per share. We have the operating leverage formula given to us as contribution upon EBIT. Right? And how do we get the EBIT? This is contribution on contribution minus fixed. And operating leverage is given as 2. 2 is equal to is a C upon C minus operating fixed cost is 3,40,000. Just simplifying it, I can say C minus, just multiplying, cross multiplying the things, minus 6,80,000 equal to C. We get the contribution as 6,80,000. The contribution is 6,80,000. Now, after this, since the contribution is 6 lakh 80,000. Uh, Question asks us to get the PV ratios. PV ratio, we know it is contribution upon sales. Contribution is 6,80,000 upon sales of 50 lakh. 6,80,000 upon 50 lakh should be 13% or 0.136. What you can write as a PV ratio. Okay. Next part is the company belongs to an industry whose assets turnover is 1.5. Does it have a high or low assets turnover? So they say at what level of sales your EBT is going to be reducing to zero. Okay, so PV ratio is done. We want to compute the earnings per share. So earnings per share, it is net profit upon number of equity shares. How do I get this net profit? Net profit will be, it's like simply the sales, or net profit will be, you can say, contribution, or fixed, because we has no sales figure that we have. Sales, we from that we are going to reduce the costs. So the net profit will be sales minus variable cost minus fixed cost minus interest. This entire thing, can I say it is after tax to be made? So it is multiplied by 1 minus t on number of the sales figure. Sales is 50 lakh, right? In fact, instead of subtracting sales and variable cost from sales, I can simply take it as contribution minus fixed cost minus interest. This whole thing multiplied by 1 minus t upon number of equity shares, right? Contribution, we can get it as sales multiplied by the PV ratio. We have the sales in the question as 50 lakh. On that 50 lakh, you're going to multiply the PV ratio, which is 13.6%, or I can rewrite it as 0.13 minus fixed cost of 3,40,000. Then this entire thing multiplied by 1 minus 0.3, which is the tax rate, divided by number of equity shares. Well, number of equity shares is simply 34 lakhs. Of course, 10 rupee, if you assume, it's going to be 3,40,000. Solve this entire thing. You'll be getting the EPS figure as 0.202. 0.202 is the EPS. Next, the question asks us what is the assets turnover. Assets turnover we have seen in the ratio analysis chapter also. Assets turnover is computed as assets turnover is sales upon assets, right? Sales upon assets, we can say sales is 50 lakh and total assets will be same as total liabilities. And what we have is equity share capital and the debentures. Assets is 34 lakh. 0.5. That's 50 lakh divided by 64 lakh 25,000. Assets turnover is 0.78, which is definitely lower than 1.5, which is the industry standard. Right? We can say this company is actually having a lesser asset turnover as compared to another industry. Then finally, at what level of sales earnings before tax of the company will equal to zero? At what level of sales earnings before tax will be equal to zero? So it's like we want a 100% reduction in for EBT equal to zero, percentage for EBT equal to zero, percentage reduction in EBT. Can I say it is 100%? So percentage reduction in EBT, EBT should get reduced by 100%. So we want to uh, know what should be the level of sales. So liquid sales when EBT equal to zero. Uh, so just prepare the income statement and you can do the backward calculation to arrive at it, right? Say start with sales less variable cost will give you contribution. From that you will subtract fixed cost, will give you EBIT. That you subtract the interest, which will give you before tax. Then less tax, give you profit after tax. Anyways, we want this PBT to be zero. If PBT is to be zero, interest is something that definitely I have to pay. So the interest is whatever we have as the debentures, 8% of 30 lakh 25,000 is 8% of 30 lakh 25,000. That's the interest that we have to pay, which is 2 lakh 82,000 is the interest. Right. So my EBT, that is earnings before interest and tax, should be exactly this figure. I need to cover up the fixed cost also, which is 3 lakh 40,000. So my contribution will be cumulative total over there, 5 lakh 82,000. Right. 5 lakh 82,000. Then going backwards, you have seen the PD ratio be 13 point 0.136%. If your sales is 1, variable cost will be 0.864. Just do the cross multiplication and get the sales figure be 42 lakh 79,412. Just doing the backward calculation by taking PBT as zero and reaching up to the level of. Okay. Now, let me answer Ranjini. Want to solve May 24 exam leverage chapter. Just give a moment while I get leverage. So, the question that we have from the some of the facts that we had from the question was here it is. So, the question that we have in the question in the Excel file and then solve it. So here's the question, the recent paper. Alpha Limited has provided the following information. Equity share capital, 25,000 shares at rupees 100 per share. For the debentures, sales as of from 50 lakh units into 24 units. Variable cost is 12 and a half, fixed cost is 175 lakhs. The recent policy changes and entry of foreign competitors in the sector, Alpha Limited expects that the sales may decline by 15 to 20%. However, selling price and other costs will remain the same. Corporate taxes will continue at 20%. Required to calculate the decrease in earnings per share, degree of operating leverage, and financial leverage separately. If the sales are declined by 10% and 20%. So I'm just giving my opinion with regards to this paper. Not providing you, something as a model answer. I'm just trying to solve it from my perspective. So, saying if the sales is going to decline by 15 or 20%, then what will be the resultant operating leverage and financial leverage? Say original, then sales decline by 15%. And one more thing we say sales decline by 20%. Let's begin. Uh, Existing sales we have 50 lakh units. Originally it is 3 lakh. Sales declining by 15%. So it means 3 lakh into say 85%. It's 52 lakh 50,000 will be the sales. And sales is going to decline by 20%, and that's it. Okay. Then from this we're going to arrive at the sales. Sale price, they're saying it is 50 lakhs. They're saying due to foreign competitors, the sales may decline. However, selling price and other costs is remain to same. That's going to remain same. So that's very simple. Sales multiplied by sale price is 20 going to be a sales. Less variable cost. Variable cost will be sales multiplied by per unit variable cost, which is 12.5. 0.5, say this is 50 lakh, 5 crore, 31 lakh, 25,000, and 5 crore on the other side. That gives us a contribution, sales less variable cost. Okay, and then from contribution, we reduce the fixed cost. Fixed cost is also supposed to be remaining same, 175 lakhs. That we get earnings before interest. Like the fixed cost to arrive at EBIT. What is EBIT? From that, to reduce the interest. Interest will be 10,000 debentures at rupees 750 each and 12 and 15%. So that's going to be 750 into 10,000 into 15. 750 to 10,000 debentures into 15%. We get profit before tax, 80 minus interest, less tax figure. Tax is the 20% PBT into 20% is the tax. Then you get a profit after tax. Profit after tax is PBT minus tax figure. This you need to divide it by number of equity shares. The number of equity shares is 25,000 shares. Income statement is ready. You have to compute what is the decrease in earnings per share, your operating leverage and financial leverage separate. So yes, is 604. We have 424 and the EPS numbers because again I have taken only this multiplied by 20 as the quantity. Cost is given as 175 lakhs. Okay, fine. Yeah. So earnings per share, we got 604, 424, and 360. If I ask you what is the percentage change, in EPS, you know how to get the percentage change, right? Is new value minus old value divided by the old value. Percentage change in EPS is 29.8%, whereas here it is 360 minus 60 divided by 604, 39.74% is a reduction in the fees. The question also asks us for the degree of operating leverage and degree of financial leverage. Degree of operating leverage is EBIT divided by operating leverage is contribution divided by EBIT, and financial leverage it's going to be EBIT upon profit before tax. What is happening as your sales is declining? As your sales is declining, you find that operating leverage is basically so is the case of financial leverage. So as the sales is declining, the risk for the company is increasing. Every decline in the sale price. That's a solution. I am not sure if it's absolutely fine or there is some other because it's not something which I'm providing you as a what is just for answers. I'm just solving it. Any queries in this or any of the topics, any of the concepts that we have learned till now? Can now just put up your queries, guys. You can post your queries. Raise your hand. I shall unmute you and love to listen your queries and equally love to answer them. Any queries, guys? Okay. Yeah. Kiran is asking or explain what is positive financial leverage and negative financial leverage. If financial leverage is in your favor, then you will say it is a positive thing. When it is not, then it is a negative. Like for example, if your cost of debt is 10%, cost of debt is 10%, and return on capital employed is let's say 25%. It's like you are getting money at 10% and you are able to reinvest that at 25%. You are raising money at 10%, but you're able to reinvest that at 25%. So it's a positive thing because taking this debt will be beneficial for you because you're able to invest it at a higher, right? And similarly, look at the cost of debt. Let's say if it is 10% and you're able to employ that funds or you're able to invest that money at maybe let's say 8%. It's a costly affair for you. It is not a favorable leverage. You're getting money at 10%, you're investing at 8%. That is something, there's a problematic area. Therefore, we say that this is not a good leverage or not a positive or not a favorable financial leverage. Okay, I hope I've answered, Kiran.
Yes, sir. But in the module, it is written if you operate below break-even point, then it is negative, and if you operate above
One
that, it
second,
is
I'm not
positive.
able to hear you. Just a moment. Increase the volume. Yeah, Kiran. Now you can speak.
Yes, sir. In the module, it is written if you operate below break-even point, it is negative financial leverage, and if you operate above break-even point, it is
In the module,
positive. Yes, sir.
module page number.
Yes, one is that is 6.13, page number 6.13.
Page number 6.16.
13, sorry, it is all modules, it is 6.13.
Yeah, 6.1. No fixed interest charges and positive financial leverage. That's what I said. Over here, when you're having financial leverage, because see here the EPS is 4 and here it is 6.5. So even if the
इसके ऊपर ही
interest
लिखा
is
हुआ है.
this one,
Yeah.
so there is no fixed interest charge. In the situation two, if you have a positive financial leverage,
Yes, sir. Yes.
then in spite of paying the interest, you see that EPS is higher for Y but lower for X because the sales level or the EBIT level is lower. So Y can easily take a debt, and that debt is acting as a increasing the EPS numbers.
Sir, 6.13 पे लिखा है ये.
6.13.
13. Yes, sir.
Page 6.13. Yeah, over here. Which one?
Yes, sir. It is written above the situation one. It's written a positive.
Uh, Kiran, can you please raise your voice a bit because I'm not able to hear you properly. Do you have
Sir,
problem
it is
with
above
this?
situation one. It is
Uh,
a positive DFL. FL means firm is operating at level higher than break-even point.
where are you? Very in 6.13, there's this question. So you want me to explain this question to you? Very specific line of the solution you are having a problem? No? When you're talking of positive financial leverage,
Yes, sir. Yes, sir.
it's like percentage change in EPS that goes from when that acts as a favorable situation for you, that's a positive. If it's not, then you say that's going to be a negative. You can say positive is EBIT level is more than the fixed financial charge. Negative is EBIT level is less than the fixed financial charge.
Yes, sir. Yes, sir. Got it.
Above situation one.
Above situation.
Yeah, so a positive degree of financial leverage means the firm is operating at level higher than break-even point, and EBIT and EPS moves in the same direction. Negative, it indicates that firm is operating at lower than break-even point. EPS is going to be negative, yes. If in spite of negative due to the financial leverage or due to interest payment, when your EPS turns negative, then you say it's a negative financial. Okay.
I was confused since it is a ratio, so how it can be negative and positive. So now I understood it.
Oh, you are not audible, Gil.
So I think there's some network problem. Now I got it, sir. Now it is clear.
Okay, you got it right. Okay.
Mhm.
Any other queries, anyone? No queries? Good. Fine. So if there are no queries, let's just stop here for the day. We'll meet up again on this Saturday, and again one more session on Wednesday. Cover up the things. Just one more topic in mind. So I'll be uploading the file, whatever we have done, this Excel file. From there, you can just refer the appropriate formulae and all the shortcuts that we have discussed till now.
Sir, what will be the topic on Saturday?
Sorry,
Which topic we will take?
weightage.
Sir, which topic we will? Okay.
Weightage as such, there is no specific, but you can get one 5 mark questions. You can even get a 10 mark question or even a 8 mark question. That may vary. There's no specific weightage that ICAI provides for any of the topics.
No, sir, I'm
Yeah,
asking which topic we will take on Saturday. Which topic we will take on Saturday?
on Saturday it is investment decision.
Thank you, sir.
Okay,
Okay, thank you, sir.
fine. So let's stop you guys. See you soon. Bye bye and take care.
Thank you, sir. Good night, sir.
Yes.
Recording stopped.